very good morning, Miss Suryani and my fellow friends. I'm Shivanita Dr. of Ramesh. My metric number is 10DLS20F2070. Here I would like to present about accounting cycle. Before starting my presentation, I would like to give a small definition about accounting cycle. The accounting cycle is a collective process of identifying, analyzing, and recording the accounting events of a company. It is a standard for 10-step process that begins when a transaction occurs and ends with its inclusion in the financial statement. First step of accounting cycle is analyze transaction. Transaction analysis is the act of examining a transaction to decide how it affects the accounting equation. It also the first step in the accounting cycle. To properly analyze a transaction, you must know and understand a few key things. And the second step is enter journal entries of the transaction. An accounting journal entry is the method used to enter an accounting transaction into the accounting records of a business. The accounting records are aggregated into the general ledger or the journal in entries may be recorded in variety of sub-ledgers which are later rolled up into the general ledger. This information is then used to construct financial statement as of the end of a reporting period. And the rules of the enter journal entries of the transaction are there must be minimum of two lines items in journal entry. Though there is no upper limit to the number of line items that can be included. A two-line journal entry is known as a simple journal entry, which one containing one line item is called a compound journal entry. The third process is transfer journal entries to the general ledger. After you record transaction in your journal, it's time to transfer them to your general ledger. To keep your books accurate, push every transaction from your journal to your general ledger. Use your ledger to classify and organize transactions when posting entries to the ledger. Move each journal entry into an individual account. Transfer the debit and credit amounts from your journal to your ledger account. Your journal and entries act like a set of instructions. When posting journal entries to your general ledger, do not change any information. For example, if you debit an account in a journal entry, debit the same account in your ledger. Besides, the fourth process is craft the unadjusted trial balance. An unadjusted trial balance is a listing of all the business accounts that are going to appear on the financial statement before year-end adjusting journal entries are made. That is why this trial balance is called unadjusted. An unadjusted trial balance is displayed in three columns: a column for account names, debits, and credits. Accounts with debit balances are listed in the left column, and accounts with credit balance are listed on the right. Accounts are usually listed in order of their account number. Most charts of accounts are numbered in balance sheet order. So the an unadjusted trial balance also displays the account number in balance sheet of starting with the assets, liabilities, and equity accounts and ending with income and expenses account. The fifth process is adjusted entries in trial balance. An adjusted trial balance is created after all adjusting entries have been posted into the appropriate general ledger account. The adjusted trial balance is completed to ensure that the period of ending financial statement will be accurate in balance. In addition, an adjusted trial balance is used to prepare closing entries. Moreover, the sixth process is prepare an adjusted trial balance. An adjusted trial balance is a listing of the ending balances in all accounts after adjusting entries have been prepared. The intent of adding these entries is to correct errors in the initial version of the trial balance and to bring the entity financial statement into compliance with an accounting framework such as generally accepted accounting principle or international financial reporting standards. Once all adjustments have been made, the adjusted trial balance is essentially a summary balance listing of all the accounts in general ledger. It does not show any detailed transaction that comprise the ending balance in accounts. And yeah, seventh process is financial statement. The preparation of financial statements involve the process of aggregating accounting information into a standardized set of financials. The completed financial statements are then distributed to management, lenders, creditors, and investors who use them to evaluate the performance, liquidity, and cash flows of a business. The preparation of financial statement include following steps. They are step one is going for verify receipt of supplier invoices. Second, verify insurance of customer invoices. Besides the third step are accurate unpaid wages and calculate depreciation. The step 5 are value inventory. Step 6 reconcile bank accounts. The seventh step is post account balances and the eighth review accounts. The nine is review financials and the tenth step is accurate income tax. The 11th step is close account. The last but not least, 12 is issue financial statements. The eighth process is close the temporary account. A temporary account is an account that is closed at the end of every accounting period and starts a new period with a zero balance. The accounts are closed to prevent their balances from being mixed in the balances of the next accounting period. The objective is to show the profits that were generated and the accounting activity of individual periods. The ninth process is prepare post-closing trial balance. This is prepared after closing entries are made. Its purpose is to test the quality between debits and credits after closing entries are prepared and posted. The post-closing trial balance contains real accounts only since all nominal accounts they account have already been closed on at this stage. Finally, the last process is reverse entries is for journal. Reversing entry is a journal entry made in an accounting period which reverses selected entries made in the immediately preceding period. The reversing entry typically occurs at the beginning of an accounting period. It is commonly used in situations when either revenue or expenses were accrued in the presenting period and the accountant does not want the accruals to remain in the accounting system for another period. It is extremely easy to forget to manually reverse an entry in the following period. So it is customary to design the original journal entry as a reversing entry in the accounting software when it is created. Thank you to Miss Suryani and my fellow friend who keep listening my presentation from step 1 until step 10. Thank you.